All right, welcome to The Explainer. Today we're going to tackle one of the most judgment-heavy accounting standards you'll ever come across, IAS 37. We're talking provisions, contingent liabilities, and contingent assets. Getting this right isn't just about memorizing a bunch of rules. It's really about mastering the professional judgment that sits behind all of them.
So here's how we're going to break this down. We'll start with the core problem this whole thing is trying to solve. Then we'll build up the rules with a really clear checklist. After that, we'll look at what happens when it's just a maybe, apply it all to some tricky real-world scenarios, and then wrap up by looking at how these rules can be, well, misused. By the end of this, you're going to have a solid framework to handle this topic with real confidence. Okay, let's dive right in. Look, if you really want to get a handle on IAS 37, you can't just memorize the rules. You have to start by understanding the why, the fundamental problem this standard was actually created to solve. And that problem is the massive challenge of accounting for uncertainty. This question, it's the heart of the matter. Just imagine you're the accountant for a second. Your company is being sued. You're offering product warranties that might cost you down the line. Maybe a huge restructuring is being planned. You know these things are going to cost money, but you have no idea when or exactly how much. So what do? How do you record that? These aren't just simple invoices. They're foggy, uncertain future obligations, and your stakeholders, they need a clear picture. Okay, so let's get to the solution. To stop companies from just creating liabilities whenever they feel like it, IAS 37 gives us a super strict 3-part test. And you have to pass every part of this test before you can recognize what's called a provision on the balance sheet. Now look really closely here. The key is to see the invisible and between each of these points. All 3 of these conditions have to be met. It's not a pick-and-choose menu. First, you need a present obligation, meaning you're on the hook right now because of something that already happened. Second, the outflow of cash or other resources has to be probable, which in accounting speak means there's a greater than 50% chance it's going to happen. And third, you need to be able to make a reliable estimate of the cost. If you're missing even one of these, you cannot book a provision. The bar is set high for a reason. So that begs the question, right? What happens if a potential obligation fails one of those tests? Let's say, for example, the outflow is only possible, not probable. Well, that's when we enter the different but very related world of contingencies. This slide shows you the crucial dividing line. It all comes down to that probability. On the left, if the outflow is probable, again, that's more than a 50% chance, you've got a provision. It's a real liability that hits your financial statements. But if it's only possible, like you see on the right, so a 50% chance or less, it's a contingent liability. It stays off the balance sheet, but you absolutely have to disclose it in the notes to make sure investors are aware of that potential risk. Now, on the flip side, what about potential gains? Well, here the rules are even more cautious. And this really speaks to that core accounting principle of prudence. We're pretty quick to recognize likely losses, but we're extremely hesitant to recognize uncertain gains. A contingent asset isn't recognized on the balance sheet at all. It's only disclosed in the notes, and even then only if the inflow of cash is probable. It is a much, much higher hurdle to clear. So we've got the theory down. Let's see how this whole framework actually applies in the real world. We'll look at 2 classic, high-level scenarios that you are almost certain to come across. This is where the rubber really meets the road. First up, let's talk about onerous contracts. This is when a company is basically locked into a deal that's guaranteed to lose money. Think about a lease on an old factory that it isn't even using anymore. IAS 37 is crystal clear on this. You can't just let the losses bleed out over time. No, you have to recognize a provision for the entire unavoidable loss right now. And you calculate that as the lower of what it would cost to see the contract through versus any penalty for just walking away. And this second scenario, restructuring, is a perfect test of that present obligation rule we talked about. A company can't just create some huge provision because its board is thinking about closing down a division. To book that provision, they have to be formally and demonstrably committed. And this requires 2 key things. A detailed, formal plan must exist, and this is the crucial part. The plan has to be announced to those who will be affected. That announcement is what creates a constructive obligation, which basically makes the company's commitment irreversible in the eyes of the world. All this talk of probable and reliable estimates, it brings us to the most challenging part of IAS 37. This need for judgment is where things can get really interesting and, frankly, pretty dangerous from an ethical standpoint. See, the subjectivity in estimating provisions, especially the really big ones for things like restructuring, can be exploited. And this has led to a pretty well-known earnings management strategy that goes by the name of Big Bath Accounting. So here's how it works. Say a company is already having a bad year. Management decides to just take a big bath. They throw every possible future cost they can dream up into one massive provision, making a bad year look truly awful. Now, why would they do that? Because it clears the decks. In the following years, they can slowly reverse parts of that oversized provision, and that reversal flows directly back into profit, making their future performance look artificially strong. And this really brings us to the core takeaway for any of you who aspire to be true accounting professionals. The rules of IAS 37 are a framework, but they are not a substitute for professional judgment and for ethics. So, as an accountant, when management comes to you with an estimate for a provision, your job isn't just to tick boxes on a checklist. Your professional duty is to apply skepticism. You have to ask the hard questions. Does this number truly provide a fair representation of where the company is? Or does it just tell the story that management wants to tell? So, the ultimate question IAS 37 leaves us with is this. This standard gives you the rules for accounting for uncertainty. But when you're faced with pressure and ambiguity, how will you use your professional integrity to make sure those rules are applied not just to the letter, but in their true spirit? That right there, that's what separates a technician from a true professional.